Hi, outlook for the week. Got a juxtaposition here as we have the second and final week of COP27 climate summit going down at an Egyptian holiday resort. And I'll be going to the Peabody coal analyst meeting on Thursday, which is going to be interesting. It's going to be another first for me, like the Schlumberger meeting was a couple of weeks ago. As energy has dwindled in the market, us energy analysts have to spread ourselves more thinly to retain interest. And Peabody's going to be quite interesting. Some people think in free cash flow terms it can earn its entire market cap over the next year. So we'll see what we think of that. There may be some language in COP27 against coal, but data this morning shows Chinese power demand up 2.2%, back to raging off the base of China. That's enormous growth that is basically being met by increased coal-fired power generation at the moment, partly because they've been backing out expensive natural gas, although that's not really the whole story because coal dwarfs gas in the Chinese energy balance. Essentially, it's been a question of meeting the booming electricity demand there. Don't underestimate how much renewables they're adding. China, in fact, more than anyone, is adding vast amounts of renewable generation and indeed vast numbers of electric vehicles. So interesting to watch, and we'll see what comes out of COP27, which we think will be absolutely nothing, and what comes out of Peabody's coal meeting, which is probably going to be some debate around their potential acquisition in Australia, but equally, an outlook we assume for cash flow and cash return. Apart from that, it's pretty quiet on the earnings front. There is retail basically reporting this week, obviously going to be less significant from both an economic announcement and a political announcement point of view after last week's, what we described as a moment in history for the US with the red wave not materializing. We think it's a very significant message to politicians that the US is essentially centrist. And that was a big moment last week, we thought, in terms of the midterms, which have now left us with a split Congress. We were saying yesterday that we're hearing from a lot of people that the market's due to rip here with the muted inflation number, with the potential for a bull run into Christmas, and that last Thursday was one of the most painful days in the history of hedge funds because of the scale of the short squeeze that occurred. But actually, a client said that Friday was incredibly painful for hedge funds as well, because every consensus short was up and every consensus long was down in any given pair that you might choose. So it's a tough market to negotiate. On Saturday, we put out a note showing you that drilling activity and production growth in the US is remaining very muted despite high prices. We don't see any significant growth beyond 500,000 barrels a day from the US, which actually is the fastest growing major oil producer. So any downside in that number has an impact on the market. Just watch out. I was at a basketball game with a Middle Eastern contact with knowledge of the matter, and he was saying that there's unlikely to be much change in Saudi exports of oil because of the cuts that they're doing are firstly to quota, and secondly because their domestic demand falls heavily as we come out of summer crude burning season. So at the margin, the key issues here are going to be the end of the SPR withdrawal and whatever happens in Russia on around December the 5th with the crude export ban, which is something that people really are not sure what the outcome will be. But our view is that given the strength of demand, and I've just read a story about how Indian oil demand is staying very strong despite the very weak rupee relative to the dollar and the very high price of oil. What we see is with sustained demand strength, and again last week, in the DOE data, we had over 21 million barrels a day of demand in the US here, which is very close to an all-time seasonal record. With that demand strength and with the weakness of oil supply growth that we had highlighted in the US, and is the case basically around the world with the exception kind of Guyana, and that's about it, and renewable fuels, biofuels basically. That's the only real growth there is of any significance, and that's really not enough to meet global oil demand, which could be up as much as 2 million barrels a day next year. The point is that we're bullish oil here, and we like the oil names despite the fact that they've been underperforming the major rip in the market. They've retained market leadership overall for year to date, and we think they'll continue to do that into next year with a target of $120 barrel Brent by driving season next year, which obviously is May 2023. We're still bullish on the grid. Have a great day.